And actually, I've met some people where I think they're going to give us a loan, but if you didn't pay it back, I mean, I joke about it, but I mean, they come after you with baseball bats to the knees to get their money back, type
I'm not
thing.
saying it's impossible, but that sounds more like the old days, the
No,
gangsters
I'm
and
I'm
things
just saying that I
like
mean if you're going through like a hard money lender, sometimes those are just individuals and they're going to fight tooth and nail to get their money back, what you owe them. Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock solid underwriting. Whether you're a seasoned analyst, an up and coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. All right. Hey, everybody. Welcome back to this episode of the Ironclad Underwriting Podcast. I'm host, Jason Williams. And again, I got my good friend, business partner, and probably soon to be co-host, but right now he's just the
hanging
recurring
out.
special recurring special guest, Frank Patalano. How are you doing, Frank?
Hey, pretty good, sir. Ready for another fun episode.
Yeah. Um, One thing that always comes up whenever somebody brings you a deal, one of the new groups that comes and brings you a deal or brings me a deal, we talk about, well, what's your waterfall structure like, right? And they don't have a clue what that even means. So this episode, we're going to discuss waterfall structures, but more importantly, where they fall in line with what the actual capital stack is for buying a property. Now, your capital stack is where's all this money coming from to buy a property?
There you go. That's what I want to know. Where's the
So
money coming from? That's the average
where's
deal. The reason why it falls apart. It's like, where's the money coming from?
so there's two main parts for where the money comes from. And when you buy a property, it comes from debt, you're taking a loan out, and then it comes from equity, money you have to put up yourself or you raise or whatever. And so when you have your debt plus your equity, that is what buys the property, that pays for all your fees, your closing costs, and everything else. And so starting off with that, and I want you to, since this is a podcast format, you're listening to this, I'm not going to share a screen. Normally I share a screen and I walk you through each step, but with this one I want you to envision like a rung of a ladder, and each item I mentioned, think of that as the bottom rung, and then you climb up a step, you climb up a step, you climb up a step. Okay, that way you get a visualization. So for your for debt, you're going to go in with like a primary debt or primary mortgage. This is going to be covering probably maybe 65 to 75% of the cost it takes to buy a property. And now, granted, if you're buying everything with cash, this doesn't really apply to you. This is I guess probably what 90% of all deals are going to be. Where you have primary debt means you sign a loan with a bank, agency debt, bridge debt, something like that. That's going to be your primary debt. And then sometimes you'll get an owner and they're like, well, I'll even front say 2 million of it. So you're paying them additional. So then that would be like secondary debt. That could be like mezzanine debt or something like that, or junior acquisition loan or whatever. So I mean, there's all sorts of different types of names for this. Um, but it would be secondary to the first. Now the first one is going to be your first lien holder. So, and typically your first lien holders does not like any other lien holders. So they don't necessarily like mezzanine debt. They don't like knowing, hey, if they default on this other loan, that other person's going to come in and take ownership. So if they find out that that's happening without you telling them and disclosing it up front, bad things can happen. I haven't seen it, but in all the contracts I've signed, that I mean, it's right there, black and white. If this happens, then bad things can happen. Usually, they just call the note due, and then you owe all of that money back, either with a refi or another loan, or you pull in equity or something.
So to break it down even more basic, to start out, if you're buying a house, you have somebody giving you the debt and you're bringing some cash, right? That cash
Yep.
we're calling equity in this deal.
Yep.
And usually there's, like you're saying, there's one primary loan. They want to have something because they're attached to the property. If you stop paying, they can take it over. They want to make sure that you have good credit and that you have some assets, or an income stream or some other way to get back their money, because in the end, they can take back the property, but they don't
Yep.
want to have to, you know.
Yep. And primary debt holder is always going to be paid first.
Yeah, I call it
Or
first position or senior
yeah,
debt. First
yeah.
position mortgage or loan will get paid first. It's the safest of the investments or of the
It,
lenders.
yeah, and so you might get a loan with what rates are, what, 5.5, 6.5% right now,
Yeah.
all the way up to maybe 7.5, depending on where you go. So they're getting a payment of 6.5, say 7.5%. Okay, that and they don't share any upside. So if you buy a property for 10 million and you sell it for 15 million, you're still on the hook for whatever the loan is. You're not, say, on the hook for the loan plus a portion of the profit. So your primary debt holder gets paid first and has the lowest amount of risk and the lowest amount of upside, or zero
It's funny you
upside.
say that. I really like how you just said that, because like I've done a lot of hard money lending. And what I like about hard money lending is that usually you're in first position. It might be a high interest rate. It's safe, but the problem is that you're basically, when you do the deal, you're telling yourself what's the max you're going to get. Because like you said, you're not on the equity side. There's debt and there's equity. And the equity side, you're getting the potential for upside,
Yeah.
you know.
Secondary debt is paid after first debt. Um, so you pay your bank first, and then you pay the owner whatever you owe him, or you pay, say you have a friend who came in at the last minute to help you get across the finish line and close this deal, and you owe him money, you pay him next. Because if the bank takes the property from you, then there's nothing you can do to pay that other guy. And then I'm not going to get into like personal guarantees or anything like that. I'm just talking about the property specific. And let's say everything is non-recourse, and we can go into that at a later date as well, different lending options. So then you have all your debt, and again, your debt is more or less a fixed rate. It's like you're all right, you're or it's going to be fixed to the interest rate, rather. Again, no upside. So secondary debt is maybe a little bit more risky than first, but it's still not. They might have a higher interest rate, but it's typically like a shorter term. And so you'll pay them after primary. And then once we get through all the debt, now we get into equity.
So
Now
before
with
you go into equity, sometimes you'll see some real last chance or emergency lenders, especially if you have a deal where you already have a lot of money out there and you don't have enough to close. You might have to do something where you're borrowing based on your credit. You're borrowing something that you're not putting any collateral up, or like emergency funding, that last chance before, on the debt side.
yeah,
Yeah. I don't want to ever have to do it. We've come close on a few deals before, but yeah, it's risky. There's a high rate of interest. What's the highest rate of interest you've seen before, Jason?
that I've seen or that I've paid, because that's totally different.
Your choice,
I
whichever one's
I
cooler.
I have seen a interest rate of one. There's a 20% um like initiation, or a rate to just kick it off. So if you're going to borrow, say, 500,000, the loan would be for 600,000, because it's 20%. So an extra 100,000. And then the interest on top of that was a lot of times it's like 18 to 20 something. Sometimes it's whatever they're projecting the IRR to be. So that would just be the interest rate that it's paid. And so then that it's basically him getting his IRR, but all up front. So, I mean, it's, we didn't have to do that, but we did investigate it. And it is definitely good knowing what your options are going into it, just in case something does have to happen. But yeah, but it's like a really short term loan, like like 90 days, 6 months, something like that. So
Yeah, crazy numbers, crazy numbers. I mean, I remember playing Cash Flow 101, and you could borrow from the bank, and it was basically 120% or 10% a month.
yeah,
So, there's no sky's the limit here. It's whatever you can negotiate because this is not a residential loan. This is all commercial. They're usually only allowing it on a property that you're never going to live in. These are investment options and risks.
yeah. And actually, I've met some people where I think they're going to give us a loan, but if you didn't pay it back, I mean, I joke about it, but I mean, they come after you with baseball bats to the knees to get their money back, type
I'm not
thing.
saying it's impossible, but that sounds more like the old days, the
No,
gangsters
I'm
and
I'm just saying that. I
the.
mean, if you're going through like a hard money lender, sometimes those are just individuals, and they're going to fight tooth and nail to get their money back, what you owe them. So
So
yeah.
that's the debt side. So now let's go into the equity side where people, whether it's partners or yourself, are actually putting money into a deal.
So so the first level, so we're climbing up, we're on rung basically three or four, depending on how many types of debt you have. The
Yep.
next rung is going to be, say, preferred equity. Now, preferred equity is going to have higher returns than, say, all your debt. Um, they're going to say put clauses in where if you don't meet paying them back, um, or you don't meet certain criteria, they can come in and run the asset. They're not going to take ownership of the asset, but they're going to run the asset and turn it around so that they see fit, even if it means selling the asset. Um, but what this means is, again, preferred equity doesn't share in any upside. They are paid, say you get a preferred equity and the rate is like 12%, they get 12% until the preferred equity is paid off. And then that's it. And then they're paid before any other equity. And so the other equity is those funds that would be going toward them or diminished due to paying preferred equity. Does that make sense?
It makes sense. On some deals, I have seen pref equity get some of the upside. It might be limited. Um,
So generally, when I see pref equity, I see maybe like they want to do it for like 18 months and get their money out, get a refinance, get out, and then move on,
Yeah, so some of them
redeploy.
might have conversion rights. Not trying to get complicated, where you know what, this is not going to get paid off as quickly as we had hoped, so they're going to convert it from a pref equity position. And they're going to still be able to get the pref equity position, but if they can't get paid off, can't get paid off, and they get some of the common share rights. But yeah,
Yeah.
that's complicated stuff.
And I want you to know every single rung of this capital stack could be super simple or super complicated. Um,
Absolutely.
have lawyers involved, write the most convoluted contract, but when you're like desperate trying to close on a property, you're going to lose 100,000 of your own money. You're going to do pretty much anything you can to save it, even if it's almost like um, making a contract with the devil. Or sometimes, I mean, it's super easy and you don't have to do that. So I mean, it's all, the sky's the limit on your options here. It's just
Well, I mean, on the second deal, this was not pref equity. I got a personal loan from someone on that on the second deal you were involved with, and it was $500,000, and it was 1.5% a month,
yeah,
and it was not tied to anything besides my good name.
yeah,
So it was definitely a debt. Technically, it wasn't a debt attached to the property in any way, but like I said, the return was 1.5% a month, and they got paid off within 6 months. And we
yeah,
could make payments along the way too to help pay it down, which was nice.
yeah. So that would have fallen under secondary debt, and they might, and they may or may not be a lien holder. In this case, they weren't. Um, and we had a I guess, secondary debt also for
Yeah, he did.
250K from
One of your
Angel's friend
friends.
and one of my
Yeah.
friends. Yeah. So, like I said, sky's the limit on how you structure these things. You can get as creative or generic as possible. Um, but yeah, so generally preferred equity that I've seen, they want out within like 18 to 24 months. They want to get just like a little bit higher return. It's not guaranteed. Not guaranteed like the primary debt is guaranteed or any of the other debt is guaranteed. And then once you do a refi, you can pay them back everything that you owe them. They're out of it forever. And then the only thing left you have now is would be common equity. Common equity is what most people think of when they hear just like equity, like GP shares, LP shares. Those are generally common equity type. And then that's where you get into your convoluted waterfall structures. And again, you can be as simple or as simple and generic or crazy and convoluted as you like. I've seen both. I've modeled both for many people. Um, but with the common equity, they're paid last. This is the highest risk out of all of it. Generally, if something's foreclosed on, the bank's going to try to get at least what they want, or at least what they have vested in it. And then all the equity and everything else just pretty much goes to zero if they just get what's owed to them. And so there is higher risk in common equity, but also common equity shares in the upside. They get
It
all
has
of
the
the
highest
upside.
chance of return and would get any of the upside.
Yeah.
So yeah, the safest bet is the senior debt, the first position debt. It's usually the lowest interest rate
Mhm.
because they get it first if the property doesn't perform, if the loan doesn't get paid. Versus this, the common equity, they get the least chance of making a profit, but if a profit is made, they get almost all of the upside to split.
Yeah. And so typically what you would see, and this is how we structure our deals, is we give our LPs a preferred return. Typically, what is it, 8%? And we do a
I've seen
70,
6, 7, 8, depends.
70-30 split. Um, I've seen 80-20 split where 80% of the equity goes to the LPs and 20 to the GPs, general partners and limited partners, without any preferred return. I mean, again, you can structure this however you want. We've talked a little bit about it before. You can be like a 90-10, where 90% goes to the LPs, 10 to the GPs, you do 80-20. 70-30 is what I typically like to do. 60-40, 50-50. And then you can actually go the other way, 20-80, depending on the deal, depending on how much work is involved, developments type thing, or international um, developments can be tricky. So,
I've never seen a 2080, but I believe it's there. I've definitely seen the 9010s. I usually tell people that's a red flag because this is just nuance that the deal is so tight that the GP has to give away so much of the money to the LPs.
yeah.
Uh, I'm in a one or two deals that are 65-35 right now. A lot of the big gurus do 50-50 splits.
Well,
Um,
then this is where we get into the waterfall.
all right, well, that's
So
what I
that
thought we were jumping into, but we can finish out the debt
well,
and
no.
equity
So
separate.
I want to step each level of a waterfall.
Okay.
Okay, so the first hurdle would be like a preferred return. The preferred return is going to be the the LP gets that preferred return before the GP gets anything. So if it's at 8%, the LPs get their 8% before the GPs get anything. Anything
The
above the
GPs
8 point.
might get a 2% or 3% acquisition fee.
Well, no, I'm not talking on the fees though.
Yeah, but no, I'm just making sure that people are aware that sometimes, I
Yeah.
mean, for example, any deal that we have that's not performing, we haven't taken any, not acquisition fee, asset management
Asset
fee.
management fee. Yeah.
Yeah.
And so the asset management fee is actually, I mean, it's a fee for running the asset. So it's going to be even before primary debt or about the same level technically speaking, because I mean it's a fee for running the property. It's like a fee you have to pay your water bill, utility bill, your property management fee, all of those fees. And we talked in a podcast, I don't know, a few episodes ago on how we make money as GPs. And so I don't want to get too much into that. So I just want to look at like where we are after everything we is after we have our NOI, we have all our capex and fees and everything taken care of. Now we're paying debt. Now we're paying equity. Um, so you have your preferred return. You have then after your preferred return, you might split it up like 70-30, where the LPs get 70% of the cash flow and the GPs get 30%. Now, here where the waterfall part kicks in is so that's technically like the second hurdle of the waterfall or the first fall after the preferred return. Then say you have all right, well if we hit an IRR, say you're projecting an IRR of 18. So if you hit an IRR of 15, then you might split it. All right, well we're hitting a 15% IRR, we're going to start splitting the cash flow 40-60% and start gradually increasing the GP shares at each hurdle. Typically, what I've seen on the most convoluted waterfalls is it eventually stops at a 50-50 split, where once you hit a certain return, all right, now we're just splitting everything 50-50. We're projecting these, we think we can get this. So then if we hit this metric, we'll split it 60-40. If we hit this metric, we'll split it 50-50. And everything beyond that will be 50-50. So that would be what, like 3 hurdles of a waterfall?
Yeah,
Um,
definitely. I mean, are you calling the split itself? You're not calling that a waterfall.
well, I
Um,
mean, the
this
water,
is the 70-30 split is, do you consider that a piece of the waterfall?
um,
No. No, it's fine if it's
no,
no. I'm just double checking. So
I
no,
don't,
so this the 70-30 split or whatever your split is the first part. And when we say 70-30, we're saying 70% back to the LPs, 30% to the GP.
yeah.
And then the next piece of the waterfall you're talking about is the preferred return. Now
Well,
we have to,
so I'm thinking about it how I modeled it.
yep.
And so at a preferred return, I am set up for 0-100. 100% goes to the LP. That way I can
Oh yeah, yeah,
calculate
I
it.
agree with you. 100% of the preferred return goes to the LP. I'm agreeing with you.
And then once that preferred return is hit, it kicks the 70-30 in for the additional cash
Yep.
flow above and beyond.
So your first waterfall you're talking about is a 7% or whatever percent preferred return.
Yep.
And we need to tell our listeners that while a preferred return might accumulate, it's definitely not a guaranteed payment. And but we do keep track of it because a lot of times, especially when you're first starting out, you're not able to pay the return, especially on a typical value add deal. It takes a while to get there, and you might not pay a preferred return for the first 6 months. You might not be able to pay a preferred return for the first year, and unfortunately, on some of the deals, you might not be able to pay a preferred return at all for the
Yeah.
entire life of the project. But if the preferred return's not paid, most of the time that money is accumulated, or if a profit's made at the end, that money would go out first because that's why it's preferred.
Yeah. Now, granted, um, it's not just free money to the LPs. It's just that they get paid first and then it's split.
Yeah, it's an
Um,
expected return based
but
on the financials that we first ran the underwriting at.
yeah. Um, and if you talk with your lawyer, they're going to send you questionnaire on how you want to do it. And there's going to be 4 questions or 2 questions. Is it cumulative or non-cumulative?
Right? Yep.
Is it compounding or non-compounding?
Right. On
So
most of your deals, what is it?
so
Cumulative,
it's
yes.
it's cumulative non-compounding typically.
Yes, exactly. That's every deal that I'm in that I know of. And not saying that there aren't deals outside of this, because you got to really read the PPM and everything else. Cumulative non-compounding is every deal that I'm in that I know of.
But and I've modeled both. actually all four options: non-cumulative, non-compounding, cumulative, non-compounding, non-cumulative, compounding, and whatever. Um, you're not going to hit all four of those because you can do non and regular on each one. But for simple math's sake, say you invest 100K, 100,000, you have an 8% pref. That means every year you should be hitting $8,000, right?
Yep.
For cumulative, if say for the first 2 years we don't do any distributions, then you're owed at going into year three, you're owed 8,000 for each year. So 16,000 for preferred returns. If it was, and that's non-compounding. If it was compounding, you would be 108,000, and then it would be 8% of that, which, pulling out my trusty calculator, because I can't do too much math like that in my head, 8.08 times, that's
8640.
8,640.
I did in my head.
Uh, I'm just, yeah, I could have done that too. But anyway, I wanted to make sure my decimal points were right. So
Yeah,
that's
you made it
800 to
easy enough. Well,
640.
technically it'd be 16,640 because you didn't pay it the first year. That's why it's
No,
cumulative.
for that's the first year. And then going into the second year, that's another. So then that's
Gotcha.
8 plus. So that's 16,640. Yeah,
So
you're
I've
right.
never done a deal that has compounding.
And neither have I. But whenever the lawyer asks you and you don't know what you're doing and you just check one, you can find yourself in a mess where you actually owe compounding legally because that's what the
Yeah.
paperwork says, and then you're on the hook for it.
So
So,
back to your waterfall. The first waterfall is your preferred return.
yep,
Now, if you have excess cash gushing out afterwards, you're talking about your second waterfall, which is how you're going to split the excess cash.
yep,
And I've seen it the same as the current split of 70/30. I've also seen it in different weird models as well.
yeah. And so, and like I said, the 8% or the preferred return is not going to be like just free cash to the LPs. So that counts toward their percentage.
Yeah.
And so you might see like a GP catch up or something like that. And that's going to even you out to be 70/30 or 80/20 or whatever you have. And then once you hit that next metric, then it's going to change to 60/40 or 50/50 or whatever. So,
Yeah. So your third part of your waterfall, like the IRR stuff, I typically see that more not figured out till sale.
you can't figure it out until the sale because
Right.
the IRR isn't determined until the project is complete.
Yeah.
Um,
That's the most confusing thing about IRR, that massive physics equation to figure out how you're doing and how quickly you're getting your money back.
yeah. So typically with like your preferred return, that's going to be a cash on cash type return. And then you're going to do cash on cash split 70/30. But then once you hit the IRR, that's all going to play in at the very end after you do the sale. So, um,
I like
again,
the least complicated waterfall as possible, by the way.
I do too. Um, but I know some big players who start adding tranches.
Yeah, yeah.
Um, and the tranche could be just like another hurdle type of the waterfall. But also, we didn't even mention common equity can have different classes as well.
Now, I was just thinking that because I was thinking about different deals and complicated waterfalls. I mean, you were talking about complicated waterfalls. We can get into that, but um, I've seen it where if you got a 20% IRR, then your percentage after that goes down. If you get a 30% IRR, then your percentage goes way down. And then, like you said, you have different classes. So you could have, and the classes are basically how much money they're putting in. I've seen classes set up differently. Some
Yeah.
classes more of a preferred equity almost.
Yeah, preferred and how I model mine is I put preferred equity
A
as its
class.
own class,
Okay.
but it doesn't benefit in the upside and it gets paid first. That's how I do that. Otherwise, whenever I do classes, it breaks it up into the proportions of equity. So if there's 20% in class A, that's how it breaks it up.
So
Um,
most of the time, like we said, with classes, it has to do with how much money you put into the deal. So I've
yeah,
seen classes that you have a $50,000 class, You have a $250,000 class, and I've seen $1 million class.
Yeah.
But it doesn't
And
have to be just classes for money. The money, can you think of other ways they might have a class?
so I typically see it based on that. And I also wanted to mention a lot of times if you're getting like fund money, like a fund manager comes and invests like 2 million with you, they might be one of the largest individual investors. And so they want additional return. One, they want to get paid themselves, and then they offer the same returns that we would offer for a lower class. So the fund manager gets paid a little bit as well. And then that's fine. A few years ago, you're able to do side letters. It's like, all right, well, if you come in, we'll offer you this percentage. And then that percentage will come off of the GP share and not the LP share, so that you're not taken away from anybody who's signed anything before. So it's like, I'm going to do a side letter. If you bring in $1 million, I'll give you a little bit extra boost or something. But then that was legal a few years ago, but then the laws changed. They're no longer legal. Now you have to disclose, say, hey, if you come in with $1 million, like this fund is doing, you could get the same benefits. Because maybe someone was going to invest 950,000. If they invested another 50,000, they can reap the rewards of the other one. So now that's why you want classes, and that's why you want, say, like 50K class, a 250, or an $1 million class. And it could be like, all right, a 50K class, you'll get a 6% preferred return. The 250 class will get 7%, and then the $1 million class will get 8% preferred return. And then it might be 70-30 for the lower classes and 80-20 for the upper classes. I mean, there's all sorts of ways you can do this. Like I said, you can do it as simply or as convoluted as you want. I know I can model three different investor classes along with preferred equity at four different hurdles for each waterfall. So that's how I can model it. I don't do that all the time, but sometimes it does come up. So
Yeah. I've seen 5 or 6 classes on one pitch deck before, and it was a crazy pants. It was so on the pref equity side, they had different amounts of minimums on the pref equity side, and they also had 3 different amounts of minimums on the common equity side. And then not only was it a 506B to C transition, but they also had a separate tranche of the investment for what do they call it when you do it online? You put in like $5,000 and stuff like that. CF, crowdfunding.
crowdfunding,
Yeah, it
like
was a big
Reg A
deal.
or something,
Say that again.
or Reg A.
Yeah, yeah. Um, I'm not trying to get complicated, but this deal was complicated. It was in Vegas. It took over 2 years to raise, and they finally finished, I think, recently.
Um, so if you are on the GP team, you're trying to figure out your waterfall structure. If you're just starting out, go as simply as possible. Um, Remember, a confused mind says
Does nothing.
no, or actually, a lot of times a confused mind says nothing, and so that might as well be a no. So if you come up with 45 different investor classes, each with 100 different hurdles, nobody's going to understand anything, and nobody's going to sign up with you. So preferred return and maybe one single split after that, 80-70-30, that's usually sufficient, especially when you're starting out. um yeah, maybe when you start getting really big, you start using fund money from different types of funds. You might want
Oh,
to
you said fund money. I thought you said fun money.
funds from funds.
I know, I'm playing with you.
So funds, and this is getting into weeds of a different topic, is say a fund manager has a fund.
I think we can have
They
a whole podcast on that, can't we?
Yeah, and you have that person has 20 different investors and they're bringing in $1 million. That fund will then go into your deal, and the fund manager picks the deal that it goes into. So it's almost like buying a mutual fund and then letting the mutual fund manager pick which stocks it goes into. Except in this case, you get the benefits of all the real estate, everything, depreciation and everything. So that is the capital stack. And remember, the very first rung paid first, lowest risk. Second, paid second, slightly higher risk, but still generally safe. Equity has the highest risk. Common equity has the most risk. Um, they're also paid the last. So that's the benefit, the risk and reward type thing. The more risk you have, the more rewards you get. You get the higher the upside on the common equity and pretty much interest on the debt. So again, if you have any questions, you can schedule a call with me. Look me up on LinkedIn, YouTube, Facebook, Instagram, any on my website, ironcladunderwriting.com. Or Frank, you can look him up in any of those
I'm
methods
around.
too. And yeah, I will catch you later. Again, this is Jason Williams, Ironclad Underwriting. See you next time. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.